everyone! What does it mean when the Federal Reserve cuts rates? And does that have an effect on mortgage rates? The Fed cut rates down to almost zero. Does that mean mortgage rates are going to go to zero? I wish. No, that's not the case. But let me explain. When the Federal Reserve lowers interest rates, they are lowering what we call the Fed funds rate. That's the rate that banks borrow money from the Federal Reserve. It's a tool the Fed can use to stimulate economy and help with liquidity in the markets. It directly affects short-term financing like credit cards, equity lines of credit, auto loans, and so all of those rates will come down. It does not have a direct impact on long-term mortgage rates. Mortgage rates are tied to the bond market and what we call mortgage-backed securities. What we've seen in the last few weeks is sell-off in both the stock market and the bond market. So that has left a lack of liquidity. There's the same demand for mortgage loans, but there's less of a supply of the money to lend. What happens in a case like that is you see rates actually rise. The Federal Reserve, in their recent rate cut, they agreed to buy mortgage bonds and mortgage-backed securities, thus replacing the lack of liquidity that has come because of the sell-offs. The good news is, as we've seen in the past, markets always recover. And we expect in the coming weeks and months that we're going to see the market settle back down, and rates are anticipated to also settle back down more into the range that we would expect given where that bond yield is at. As always, I welcome your calls and your emails. Please feel free to reach out to me anytime I can help.